right. In our last discussion, we delved into Nauticus Robotics Inc. kit. Today, we're turning our analytical lens to XTI Aerospace Inc. Now, this is a company trying to position itself right at the cutting edge of advanced air mobility with its TriFan 600 vTOL aircraft. And they also have an industrial IoT segment running alongside it.
Right. And the central question today, I think, really boils down to this. Is XTI Aerospace fundamentally an innovator on the verge of a real breakthrough with this aircraft technology? Or are the financial headwinds, the constant need for cash, the dilutive offerings, are they just too severe? Do they overshadow the tech and will ultimately undermine the whole thing for shareholders?
Exactly. So I'll be making the case for the company's technological strength and its market potential, why that long-term vision might be worth, serious consideration, despite the current numbers.
And I'll be focusing on those significant financial risks, looking at the numbers and what they really mean for shareholder value, especially given the track record.
Okay, so let's start there. XTI Aerospace Inc. Really is positioning itself as an innovator, driving, I think, pretty substantial progress in this growing VTOL market, vertical takeoff and landing, with the TriFan 600. Now, yes, the financials, they definitely reflect the development stage. That's clear. But if you look closer, the strategic moves, the industry validation, they point towards considerable long-term potential. We've seen some really significant development milestones for the TriFan 600. First off, the FAA, the Federal Aviation Administration, accepted their type certification application. Now, that's not just paperwork. It's a huge step. It basically signals the FAA is ready to start the really rigorous, multi-year, very expensive certification process.
Okay, accepted the application, but that's just the start of a very long road, right?
Absolutely. It's the start, but a crucial start. And beyond that, they've completed numerous critical reviews, things like flight technical familiarization, propulsion systems assessments, aircraft structures reviews. These aren't just, conceptual checks. They're deep engineering validations. They show real, tangible progress on the design and how it actually functions. And you see design efforts too, like the flight deck mock-up, updates to the fuel system, the engine air inlet, the exhaust. It all underscores the depth of the development. They're moving from ideas to concrete engineering. And then look at the partnerships. They've fostered some really strategic collaborations. Think about their work with Maglev Aero on electric propulsion systems. That could be a game changer for the TriFan 600's efficiency. And they're working with the Department of Energy's Oak Ridge National Lab, using their supercomputers for advanced computing to speed up complex simulations and design work. These aren't just, press release partnerships. They bring real R&D muscle. Plus their corporate advisory board, it's been seriously beefed up. Leaders from AI, national security, aerospace, people like Charlie Burgoyne, Steve Griesel, even former Apple and Pratt & Whitney technologists. That kind of expertise is, frankly, invaluable for navigating certification and planning strategic growth. And finally, you're seeing market validation starting to emerge. There's a conditional pre-order for 100 TriFan 600s from Mesa Airlines. Now, okay, it's conditional, but it's still a strong signal of commercial interest from an established airline. That's a pretty powerful endorsement for a pre-revenue aircraft. And let's not forget the diversification point. They have the industrial IoT segment with Inpixon, that's their RTLS solution provider. That segment actually generated $3.04 million in sales last year, with a pretty healthy gross margin around 45%. It provides some revenue during this really intensive R&D phase for the aviation side. It offers a bit of stability. And, this single analyst covering it has a strong buy rating, a 1.00, and a target price of $12. That's way above where it's trading now, obviously, reflecting a belief in that future growth story.
Okay, I hear the points about the technology and the vision, and, advanced air mobility is exciting. But when we strip all that away and just do the cold, hard financial analysis, the picture for XT Aerospace looks, frankly, alarming. The company faces severe, really persistent challenges that I think significantly undermine the investment case, regardless of how cool the plane might be someday. This pattern of shareholder dilution combined with just deeply negative financial performance, It suggests that tech dreams just aren't translating into sustainable value, at least not yet, and maybe not ever for current shareholders. Let's start with the shareholder value destruction. It's been catastrophic. The stock was trading at $1.53 on September 12, 2025. That was after dropping nearly 25% in a single day.
Yeah, that was tied to the offering announcement.
Exactly. But zoom out. It's down, 97% over the past year. And maybe the most shocking figure, it shows a negative 100% return over the last 3, 5, and 10 years, compared to a 52-week high of over $60. Now, a negative 100% return, that basically means total capital loss for anyone holding over those periods. This isn't just, a rough patch. This is a consistent, dramatic erosion of capital. And this destruction is directly linked to aggressive and persistent dilution. The company just keeps going back to the market for cash via public offerings. And for investors, dilution means each new share issued makes your existing shares worth less, like slicing that pizza into more smaller pieces. The examples are pretty stark. That $20 million offering announced September 12th led directly to that 25% drop. Before that, June 2025, a $16 million offering was priced. Stock dropped almost 40%.
January 2025, another $20 million offering. Stock dropped over 42%. These aren't just financing growth. They're happening frequently, often at big discounts, and they demonstrably hammer existing shareholders. It really looks like what many call a death spiral. Raise cash, stock tanks, need more cash sooner, repeat. Now look at the core financial metrics. They are just unsustainable. XTI reported an income of negative $52.66 million. Earnings per share trailing 12 months is negative 48.58. Those are just eye-watering numbers. The operational margin is negative 940%. Profit margin negative 1735%. Yes, okay, the IoT segment had a 45% gross margin on its $3 million in sales, but that tiny positive is completely swamped by the enormous operating losses. A $52 million annual loss against $3 million in sales. The cash burn rate is extraordinary, and what's worse, that small revenue base is actually declining. Sales growth over the last 3 and 5 years, negative. 41% negative over 3 years, 12% negative over 5. Quarter-over-quarter sales dropped almost 42% recently. So, falling revenue, massive losses, yet you still see valuation multiples like a price-to-sales ratio of over 10. That PS multiple suggests the market values each dollar of revenue at 10 times, which you might see for a hyper-growth tech company, not one with declining sales and huge losses. And finally, there's what looks like a lack of real confidence from insiders and institutions. Insider ownership is tiny, 0.47%. Institutional ownership is just over 10%, and we don't see any recent public data showing insiders buying shares. That low skin in the game from management, it's concerning for a company that needs everything to go right in the future. It raises a red flag about alignment with shareholders.
Okay, I appreciate you laying out those financial realities. They are challenging, no doubt. But I think framing XTI solely through those traditional metrics, it kind of misses the context here. We're talking about pioneering revolutionary technology. Developing a complex vTOL like the TriFan 600 is just inherently capital intensive. It needs huge upfront investment, R&D, certification long before you see any significant aviation revenue. It's pretty typical for these kinds of high-tech, pre-revenue R&D efforts, especially in aerospace. And look at their balance sheet structure. The low debt-to-equity, 0.03, and long-term debt-to-equity around 0.02, that shows a very conservative approach to using debt. They're funding this mainly through equity. Yes, it's dilutive, as you pointed out, but it's often the only path when banks won't lend against unproven, long-horizon tech. The cash per share, around 99 cents, means they do maintain some liquidity for operations and development. It feels like a strategic choice. Make a big bet on future value, avoid debt that could crush them if things get delayed, and accept the equity financing reality.
I'm sorry, I struggle with the idea that the magnitude of these losses and the sheer frequency of dilution is simply typical, even for this industry. Yes, R&D is expensive, but over $52 million in annual losses against just $3 million in sales from a non-core segment, That feels like an unsustainable cash burn, raising serious questions about efficiency, not just investment. And the constant need for offerings, multiple times in a single year. It confirms that whatever cash they raise just gets burned through incredibly quickly. It's not strategic, long-term financing. It feels like a treadmill just to keep the lights on. That 0.99 cash per share, with a $52 million annual burn rate, how long does that really last? You also pointed out the enterprise value versus market cap. The fact that EV is so much lower suggests a big chunk of the market cap is just the cash they hold. Cash that's rapidly disappearing. So the market might be valuing the dwindling cash pile more than the long-term vision. And sure, low debt is good in theory, but if the alternative is this relentless dilution, is that really a prudent strategy for shareholders? I'd argue it's debatable.
Okay, I see the concern about the burn rate. But let's pivot back to the tangible progress and market acceptance, because those are critical indicators, especially for an aerospace venture. These FAA review completions, the flight milestones, getting the type certification application accepted, these aren't just theoretical. They are concrete, essential steps. I mean, bringing any new aircraft to market is a decade-plus regulatory marathon, even for established players. XTI's progress on these hurdles shows a structured and so far successful development path. And the Mesa Airlines pre-order, 100 aircraft, yes, conditional. But it's still a major regional airline saying, we see a potential future for this aircraft in our fleet. That's market validation. It shows the concept resonates. And again, the industrial IoT segment, it is generating revenue and a decent gross margin. It validates their capability to run an operational business, even if it's modest compared to the aerospace ambition. It's not all just future promises.
That's fair on the technical milestones, and FAA progress is important. I absolutely concede that. But has any of that progress actually translated into a single dollar of aviation revenue yet? No. And that Mesa pre-order, while a positive signal, remains conditional. The whole advanced air mobility market is still very, very early stage. These pre-orders often have huge outs tied to certification, manufacturing, performance, milestones that are potentially years away. There's a real risk they don't convert, or the terms change. And that IoT segment? $3 million in revenue is, let's be honest, a drop in the bucket compared to a $52 million annual loss. It doesn't move the needle financially. Plus, this classification issue, one source calling them services computer programming services, while they promote themselves as an aircraft maker, it does make you wonder about the strategic focus. Is the tail wagging the dog in terms of where the actual, albeit tiny, revenue comes from? The market typically values an aerospace company for its planes, not a small software side business. And that analyst target of $12 compared to a stock price around $1.50, it just seems wildly optimistic given the current financial reality, the time frame, and the dilution shareholders have already suffered and likely face going forward. It feels disconnected.
Well, I'm not sure the current revenue mix or one analyst target should completely overshadow the strategic efforts and the genuine investor engagement they seem to be attempting. They do hold investor webinars. They put out updates on their 2025 momentum. The CEO, Scott Pomeroy, writes articles in Forbes about the vision, the advisory board appointments we talked about, bringing in serious expertise. All of that is aimed at building confidence, reassuring investors about the long-term plan, especially during this tough phase. That transparency, that influx of talent, it provides a qualitative story that maybe counterbalances some of the raw numbers. You can't build something this ambitious without communicating clearly and attracting the right people.
See, I look at investor confidence very differently. Webinars and articles are, part of the narrative management, but the hard data on ownership tells a more direct story about real conviction. That incredibly low insider ownership, less than 0.5%, and modest institutional ownership around 10%, with no recent insider buying reported, that signals a potential lack of belief from those who know the company best. If management truly believed this was undervalued, despite the challenges, you'd expect to see them buying shares personally, not just talking publicly. It suggests maybe they aren't putting significant personal capital on the line. And that high institutional transaction rate, nearly 88% turnover. That could easily mean institutions are just trading the volatility, flipping the stock, rather than investing for the long haul. They might be churning out, not holding with conviction. So this low internal alignment, coupled with the nonstop dilution, I think that erodes genuine investor confidence far more than a webinar can build it. Ultimately, the market's reaction, the stock price collapse, reflects deep caution and skepticism, not conviction. Trust in the end is built on results and aligned incentives, not just communication.
Look, XTI Aerospace is undeniably tackling a transformative industry. And yes, the financial hurdles are very real, very significant. But they have shown clear, incremental, and externally validated progress on the TriFan 600. The heavy investment, the losses, they're arguably a necessary phase for a company trying to pioneer something entirely new in air mobility. The partnerships, the talent, the early market signal from Mesa. It all points to a compelling, though definitely high-risk, long-term story. They could be poised for future success, even if the path is arduous.
And while that technological vision is ambitious, the cold financial data just reveals this brutal pattern. Dramatic shareholder value destruction, a constant dependency on dilutive funding, and operating results that are deeply, deeply negative and nowhere near covered by current revenues. So investors really have to weigh that speculative future potential, however exciting, against the very real ongoing financial damage and the stark erosion of capital shown by the market over years.
It certainly highlights that complex tension between innovative engineering and harsh financial realities. It invites a much deeper look at the risks and potential rewards in these emerging capital-hungry sectors.
Absolutely.